Well, with the third plenum of the 18th CPC Central Committee ending early this week, what's next for the Chinese economy? Our reporter Martina Fuchs spoke to the Asian Development Bank's head of economics unit for China, Jürgen Conrad, about his take on the planned market reforms and, of course, the wider economic implications. Take a look.
Markets will play an even more important role than in the past, and the role of the government will change accordingly. This is potentially revolutionary. We have also heard that there will be a more permanent group which will supervise the development and implementation of reforms.
The government pledged to let markets play a more decisive role in the economy with this new reform push by 2020. What kind of concrete changes are you expecting for the economy?
Well, if the role of markets and the government are being rebalanced, that has potentially far-reaching consequences for many, many areas. I think we will see much more investment, private sector investment in the financial sector, and credit will be increasingly allocated based on market principles.
The government also reiterated its goal to liberalize the market-based policies and possibly widen the RMB exchange rate band. How soon are you expecting these reforms to kick in?
I think the central bank will wait for a good window of opportunity when the currency is not under clear upwards and downwards pressure, so the market is more or less balanced.
Fiscal reform was another hot topic, and how to improve the budgeting system and deepen the tax reform. Where does the ADB see most need for action in this area?
Very important is that local government finances are put on a sounder footing. We believe that central and local government revenues and responsibilities need to be rearranged. At this stage, many local governments don't have sufficient resources, tax resources, and have no choice but to run into debts.
After the meeting, is the ADB still keeping its 2013 real GDP forecast of 7.6%, or are you adjusting this rate?
The annual growth rate will almost certainly be 7.6 or 7.7%. What is more interesting is the outlook for next year. We believe that growth will further decelerate, perhaps to 7.4%, maybe a little bit lower. We think this is better than pushing growth up by investment programs which come with higher debt levels again of local governments and SOEs.